Hello investors, today I'm going to be talking about a boring, reliable dividend stock that you should buy if you kind of want long-term dividends and slow, steady growth over a 20-year or longer period. That stock is ADP, or Automatic Data Processing Inc. ADP is a human capital management or HCM organization that is highly diversified and has an impressively high recurring revenue rate of around 92%. The company offers many different services, mainly including their cloud-based human capital management. They operate in two main segments, employer services and their professional employer organization or PEO. Both segments offer mostly cloud-based solutions for companies, and they help automate payroll for around 1.1 million clients across the world and 140 countries. I think the company has solid financials with revenue being around $20 billion and a revenue CAGR over the last 10 years of around 6.5%. Nothing extraordinary, but consistent growth over that period is what we want to see. They also have around 2.5 billion in bookings and a revenue portfolio of around 19.2 billion, which is well diversified. PEO making around 32%, small businesses is around 18%, and majors account along with international is at 15 and 14% respectively. Their client funds flow is around 3.3 trillion and they've returned around 30 billion in cash to shareholders over the last 10 years. Oh, perhaps the most impressive stat of all, they've grown their dividend for 51 consecutive years, making them a dividend king. Now I know that was a lot of financials, but you're probably here wondering, why would I buy this company over a tech stock like Google or Amazon? Here's the honest answer. If you want explosive growth, this is not the company for you. ADP is a slow compounder. The stock actually pulled back recently, and this is never a company you should buy expecting it to double in 5 years. What you'll get is a steadily growing income stream where your dividends slowly and gradually compound year after year. For the right investor, someone playing like the long game, that is very valuable. So why is this company so reliable? I'd say the answer is switching costs. When a business signs up for ADP, they hand over the keys to their entire workforce, every employee's salary, tax record, bank details, benefit plans, retirement contributions, etc. ADP automates everything, calculating net pay, filing taxes across every state and country, and making sure everyone gets paid correctly and on time. To switch providers, a business would have to re-enter all of that data, retrain their entire HR team and every benefit, 401ks, whatever, and that could cause errors and legal risks. The risk of switching simply isn't worth it for most businesses, which is why around 92% of their revenue is recurring. Once a client is in, they typically tend to stay in. Now let's talk about the positives going forward. First, the interest rate environment. ADP holds enormous amounts of client funds, briefly paying them out. When rates are elevated, they earn meaningful interest income on that flow, essentially free money on top of their core business. Second, their investment in generative AI has real potential to reduce certain operational costs and improve margins over time. This isn't a flashy AI story, it's a quiet, practical use of their technology to make already efficient business even more efficient. Third, ADP has the opportunity to combine all their international platforms, which could drive improved profitability in regions where they still are scaling. Now for the negatives, because no stock is perfect, the biggest risk is competition. The HCM software space has seen a wave of new challengers emerge in recent years. Companies like Rippling and Workday are aggressively hitting ADP's market, particularly among mid-sized businesses. This could create pricing pressure that squeezes margins over time. ADP is also tied to employment levels. The more people that work, the more ADP earns. The less people that work, the less ADP earns. In a significant economic downturn where employment rises sharply, their revenue would feel it. That said, on that front, the latest ADP National Employment Report showed around 33,000 new jobs added, which is an encouraging sign. There's also the longer-term AI risk. While ADP is investing in AI, a truly disruptive competitor that uses the AI to do what they do could undercut them on the price, which obviously would hurt margins, hurt profit, and could be a serious threat down the road. One thing that often gets overlooked with ADP is the quality of their management. CEO Maria Black, who took over the company in 2023, has continued the disciplined capital allocation strategy that has defined ADP for decades. Management consistently prioritized three things: reinvesting in the platform, making targeted strategic acquisitions, and returning cash to shareholders. That 30 billion returned over 10 years doesn't happen on accident. ADP also runs a capital-light business model, meaning they don't really need to spend much cash to make money. It also means they don't have to spend much to grow the business. That is a big reason the dividend has been so reliable over the years. The cash flow is consistent without requiring massive reinvestment. Management is also notably disciplined about their acquisitions. Rather than chasing flashy billion-dollar deals, they make targeted purchases that bolt nearly into the existing platform. And their investment in compliance infrastructure, staying ahead of constantly changing tax laws across 140 countries, is a genuine competitive advantage that it's very hard for smaller companies to replicate. The honest risk with management is execution of this AI strategy and then combining their international platforms. These I feel are the right things for the business to be doing, but they do require near flawless execution. Any mistake that could affect payroll reliability, even briefly, could damage the client trust that took them 50 years to build. On valuation, ADP is never going to look cheap, but currently the numbers are reasonable. A price to free cash flow of around 16 times and a payout ratio of around 70%, which is on the higher side but is very manageable given the consistency of their cash flows. The dividend yield sits around 3.5%, and with a 51 consecutive years of dividend growth behind it, there is every reason to believe that streak continues. Overall, ADP is not a stock that will excite you with massive numbers and massive growth, but it is a long-term stock if you want to buy for slow compounding growth. The business is very durable and sticky, which makes it very hard to argue against. Sometimes the boring stocks are the best.